Joining us now with more on the tech rally and her top picks, JoAnne Feeney. She's the portfolio manager at Advisors Capital Management. JoAnne, let's start off with Nvidia as it approaches a $2.8 trillion market value. Has it gotten ahead of itself?
Yeah, I don't think so, David. I mean, it's always the case that, a stock's price will build in its future, right? And its future growth prospects are really quite impressive. But to put it in perspective, notice that Nvidia's earnings over the last year have gone up 460%. Its stock has gone up 250%, but earnings, are leading the way. And so actually the multiples come down in the last year. Nevertheless, right, the stock continues to rise on expectations that its growth will be more long lasting than for many other companies in the market that investors can own. So that's why the stock is where it is. And we do see an awful lot of growth ahead of it. Competition is coming, but it's going to take some years for that competition to make inroads.
Yeah. And what else then? I mean, to the extent that obviously we sit here and talk so often about this opportunity when it comes to to generative AI, beyond Nvidia, JoAnne, are there other names that you think are particularly the greatest beneficiaries?
Well, there's a lot of ways one can invest around AI. Obviously, the picks and shovels through Nvidia is one way, but another way in that same group is a company like an AMD, which is developing chips coming out this year to do also some work in AI, more on the inference side. But that's a real opportunity, and they continue to gain share against Intel and servers and PCs. But beyond that, look at a company like Broadcom. It's more diversified. It's not only in the iPhone, but it's also enabling AI inference chips with the collaboration with Google. So, that's an opportunity. Plus, they're diversified into enterprise, into cloud. They have yet to reports coming up in a couple of weeks. Look for some weakness on the cloud and enterprise side, but their opportunity in AI is really quite strong, and they generally have very high margin businesses because of their deep technology moats.
I know we're in growth mode for all these companies in terms of adoption and demand, but how do you think about the sustainability of revenue growth for some of these companies that are in early, and how long that lasts?
Sarah, it's so interesting to look at those Nvidia numbers as just an exclamation point on how the world has changed. You look at their growth last quarter, 460% earnings growth. Boy, that's going to drop an awful lot this quarter. It's only going to be 260% earnings growth. But this is just this big step up change in the opportunity ahead of them. A year from now, Nvidia earnings are likely to be growing at 25 to 30%, and that's in expectations. Other companies that are just getting involved, right, will not see the same kind of step up. This really was a unique opportunity for Nvidia. But, look into the software side, too. A company like ServiceNow, which we own in our growth strategy, is a company that's deploying applications enabled by AI. And so it's really hard to sort of get your head around some of these multiples because a lot of the earnings and the cash flow is ahead of these companies. And so, this is an unusual time. It does take thoughtfulness about which companies really have developed applications that customers are paying for. So those are a few examples.
Hey, JoAnne, there's been some chatter that to the degree that there's a risk of a melt up, a lot of that's going to come from retail participating a lot more in equities. We've got these Robinhood metrics we watch. The memes are back. Nvidia splitting 10 for 1. Are you in that school?
Yeah, we tend to think that the market's going to be driven, more by the institutional investor. I think that the 10 for 1 split at Nvidia and other companies that have done something similar really helps the employees. It enables them to give them, stock options, et cetera, in the company. And we think that's useful and certainly helpful for retail investors to be able to own some of these things in their portfolios. But, overall, what we're watching more broadly is the strength of the consumer. And while they don't have that big stockpile of savings to work off of, they still are, basically seeing a world in which they can get jobs if they want them, where their nominal wages are still keeping now ahead of inflation. So the spending power of the consumer is still pretty solid. But on the flip side, there are those concerns about how much they're borrowing against, paydays coming up in the future through those new apps. There's concerns about, credit card balances, although relative to income, they're not at high levels. But some segments of the consumer are clearly suffering. And we're seeing that in the reports from some of the retailers who are talking about a little bit more price sensitivity among their shoppers.